The Money Show.
Personal Finance with Warren Ingram.
Well, I don't know if you've ever come across this debate, but it is one of the more interesting debates that you find in investing. And the argument is around whether or not you should just bet the entire stock market index, or if you should in fact invest with a fund manager who manages your money for you. So if you were, for example, to bet on basically every stock in the JSE, you put money in and the fund will then distribute the money according to a weighting across all of those stocks, and then it rises and falls with the index is one way of doing it. The other is to then actually invest it with fund managers, and they will decide where to put your money. They will make bets on what's going to happen in the future and all the rest. And that's going to be the focus of your conversation with Warren Ingram this evening on personal finance. Just battling to get through to him. We'll have him for you, I understand, in just a moment. And just to essentially continue with this conversation, it is, by the way, in some ways, an incredibly divisive argument. You can imagine people who are paid to manage money, how they feel about this debate. And then, of course, you can imagine people who are the beneficiaries and how they feel about all of this. Warren Ingram with us now. Warren, I suppose we need to start off with the real difference between an index investor and a fund manager. And I suppose one's active and one's not quite not so active.
You're right, Stephen. It's one of those those fiercely held debates now between the industry professionals and the not so new kids on the block anymore, but the index investors. And I think we're probably all a lot more familiar with fund managers. So those would be, and I say it with no sarcasm, very bright, very well educated investment professionals who very focused on doing deep research, understanding what drive markets and particularly what they invest in. In other words, if they're share investors, they will try to understand markets and specifically the companies they want to buy and those they want to avoid. And that would apply to bond investors, property investors, and the like. And they've been doing this job for as an industry for well over 100 years now. And they're typically brands that we would know very well. They advertise at airports, on TV, sponsor, sport and all those kinds of things. And typically very good at marketing, the top ones, and telling their story in a very compelling way. So those would be fund managers. And on the other side of the equation, the slightly newer industry would be companies that decide to offer you a way of buying an entire stock market or as much of a stock market as possible, but doing it with one investment. In other words, you buy the top 40 shares on the JSE, which are generally acknowledged to be the bulk of the value of the stock exchange in South Africa. But instead of going to buy all 40 of them or buying a unit trust that chooses some of the top 40, you buy one index tracker. And what it does is it buys every single one of those 40 shares, and it does it in proportion to their size. In other words, if company A is the biggest company on the stock exchange, it's the most valuable, then that would be the proportion that you would have. You'd have the same proportion in your index tracker right down to the 40th biggest company. And the job of an index manager is to track that index as closely as possible and to do it as cost effectively as possible. And I guess I haven't mentioned the C word until now, but that's the key point here is index trackers are generally at least half the cost and sometimes a tenth or a thousandth of the cost of a fund management equivalent product.
We're talking to Warren Ingram this evening on personal finance, 011 883 0702 021 446 0567. Your questions for him about your money. Warren, I suppose one of the great things about an index investor is that once it's going, you don't really need to do anything. You can just leave it. You just lose it. You don't have to do anything with it. It'll just chug along.
It will, and I love the analogy. I think it's true. You can fire and forget, and I think the reason that's important is the real job of you and I as people who want to invest our money and want to get to the point of financial freedom is we need to stay invested in stock markets, bond markets, property markets for absolutely as long as possible, and not fall to the temptation of adding a bit extra when everyone else is doing well, or even worse, panicking when everyone else is panicking, and then selling in a kind of a mindless rush to exit the doors. And that unfortunately is repetitive human behavior. We see that in South Africa and everywhere else in the world. So the one thing about an index is you know what you're buying when you buy it. If it's the top 40 again, just to use that as the example, it is what it says on the box. It's the top 40 biggest companies. You buy it. Your job is to keep adding money when you can, and to do that as regularly as you can, and then do everything you can not to sell until such time as you want to draw on that money to fund your life and your cost of living. So it's very much easier to just buy it and carry on. The problem, in contrast with a fund manager, is you do need to do some monitoring, and by all means, don't monitor it every day or every week or potentially even every month, but you will need to keep track of that fund manager. Number one, to understand if there are any changes. Have some of the people left or have new people joined, and what are those new staff like? Are they better than the old lot, or they're worse? What's their experience like? And then, very importantly, are they sticking to what they said when you bought into their approach? In other words, if they say to you, our job is to find the best unloved companies on the stock exchange. In other words, these are the ones that are not popular and not tracked by the markets in general. Then you need to make sure that they're continuing to do that and not suddenly falling prey to the latest investment fashion and buying the most popular company on the exchange. So you've got to make sure that they're sticking to their knitting and making sure that that they're doing what they say they're going to do. And that's particularly important when they're not delivering good returns. So if you buy a fund that says, I'm a global fund and I buy shares that look nothing like tech shares, I'm going to buy companies that are old world manufacturing businesses, then they've probably had a fairly lousy time over the last 4 or 5 years, because pretty much tech has attracted all the money in the world. And so what you don't want to see in a fund like that is suddenly they start buying Apple and Microsoft and Nvidia, because they're not sticking to their knitting. They've changed their whole philosophy. And that's dangerous when a fund manager changes its spots. It's a bit like a leopard. A leopard is a leopard. It's not a lion.
When you talk about that, so I mean, one of the things we've seen over the last 24, 36 hours is what's happened to Nvidia, which was the sort of tech industry darling in the US, and they lost 17% of their value. That's over $500 billion. It's just an unbelievable amount of money. How would that affect an index share? So an index investment. So I am presuming if the way those products work is the more expensive a company, the more valuable it is, the more money they put into it, you would have come away yesterday feeling a bit sorry for yourself.
You're right, and it's been the critique of index investing for a very long period of time. It's the fund managers in particular would say that what you're doing is you're chasing yesterday's winners, and using Nvidia as the example, it's the share that's done incredibly well in 2023 and 2024, and it's phenomenally expensive as a share. It's got to make something like 45 years worth of profits to justify the current price, and it's the biggest company around. And so what you're doing, if you're an index investor, is you're buying and holding the thing which has become most expensive. And so when the markets turn and the expensive share, or in this case, they talk about the Magnificent Seven. It's the 7 big tech-related shares have attracted the most money. They are between those 7 and maybe the top 10 shares on the S&P are I think about 35 or 38% of the value of the S&P, or it was on Friday evening, and maybe not so much by now. But at the same time, that's been a criticism of indexes all along. Indices always attract the winners, and they always become the bigger shares in the market. And then this is the criticism. The truth is, Stephen, when you look at an index versus the fund management universe of managers trying to beat the index, they can't do a very good job, these fund managers. In fact, somewhere around 8 out of 10 of them can't beat the index, even with all these obvious flaws of having concentration risk and all these eggs in one basket. And so I almost want to say, yes, you are buying something which has some concentration risk, and that's true. The antidote to that is don't put all your money into the index at once. Make sure that you're doing it in batches, whether it's monthly or every 6 months. That's a great way to smooth out that potential danger. But the prospect of you doing better than 80% of all the other fund managers out there is very real. And I wasn't the best student at school. If someone had said to me, you don't need to study and you're going to get 80% for every exam, I would have taken it. And that's what happens when you buy the index.
Mm. Sure. Very interesting way of looking at it. I like that. You don't need to study, you still get 80%. When you have an active fund manager and they, I suppose, would act against an expensive share, they would say, look, you can't put too much into NVIDIA. But up until Friday, every client in the world would have been onto their fund manager saying, buy more NVIDIA. I mean, this is where it gets quite messy.
Yes, and it's certainly been a raging debate because if you're a fund manager that says, I buy growth companies, I buy companies that I believe have a very high potential to grow themselves, their profits and their dividends, etc., then NVIDIA would be a big call. And owning the Magnificent Seven would have been the most important decision. And the temptation for those managers would have been potentially to buy even more than what you would normally find in an index in those shares. So the potential for risk can escalate there. Having said that, there will be a group of fund managers. They're generally called value managers who would look at that and say, there is no way I can justify paying 45 years worth of profits right now for one share, because that share has to deliver enormous growth year after year after year and deliver perfect performance in perfect conditions all the time. And so, yes, they would have clients that would be unhappy with them when NVIDIA is doing well. But over the last few days, those same clients would probably be breathing a sigh of relief that they've got exposure to value managers. So I think that, and I don't want to knock fund managers. I actually believe they have a role in the world now. But the trick there is they need to charge fairly for their fees, and they do need to have a very clear mandate and then exhibit discipline around that mandate. And I think value managers, right around the world have been punished because, low interest rates have suited growth companies a lot. And potentially now we're in an environment where interest rates might be high for quite some time, for a few years. And that should be very good for value managers. And we might see, that number of only 2 out of 10 fund managers outperforming. Maybe that starts to increase. And then we start to realize that actually fund managers can do a good job for you, but maybe it shouldn't be one or the other. It might need to be a combination of the two.
Warren Ingram with Personal Finance this evening. He's co-founder of Galileo Capital. And we have a question from Michael Warren. He says, hi, I'm planning to invest a significant inheritance that was recently paid to me. I've tried to do some reading about when to invest because the world seems a little unstable right now and stock markets have been great over the last few years. Should I wait for everything to calm down before I invest? Very interesting question from Michael. We'll have Warren's response in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
We had a question for Warren. It was from Michael saying, I'm planning to invest a significant inheritance, but worried about the world looking a little unstable now. Stock markets have been great the last few years. Should I wait for everything to calm down before I invest? Warren, it's a really interesting question. I mean, do you wait or do you always invest now?
It's human nature and almost, intuitively common sense to say, it doesn't make sense to allocate my money to markets when we've still got a huge amount of geopolitical uncertainty in Europe. We've got Donald Trump, who could do anything and will do anything in the next few days, weeks, and months. And then you've got the bugbear of inflation that hasn't really gone away. And if you've got an inheritance that might be life-changing money for you, the temptation to sit on the sidelines and wait for things to calm down and to normalize is very understandable. Unfortunately, Stephen, it's not that easy. It's not that simple, because what you really want to do if you're an investor is you want to be the person that runs into the burning building when everyone else is running out of it, because you've got to buy assets that are at a good price, that offer good value. You don't want to buy things that are already very expensive and priced for perfection. So you're looking for opportunities to get into investment markets, and especially stock markets, when people are most uncertain, when people are most emotionally unstable and most fearful, because that's generally when they would be selling assets at a low price and potentially transferring their share exposure to cash, and they would be sitting on the sidelines waiting for things to get better. And that's the exact time when you want to be allocating more and more of your money into investment markets, because the price you pay for an investment has a huge outcome on or influence on the outcome of your money over a long period of time. So if you buy something that's phenomenally expensive, it can still grow for you over a decade, but the chances of growth are less. Whereas if you buy something that's high quality but very cheap because you bought it when everyone else was panicking, you've given yourself a great chance of getting very good growth over a 5 and 10 year period. So what I do know is we can't time these things. The world might get much more unstable in 3 months' time, or suddenly, great stability returns and everything goes well. So when you're investing your money, you have to be really humble enough to say, I can't forecast what the outcome is going to be of the weather tomorrow, let alone what's going to happen to investment markets over time. And so when you've got a large lump sum and the world is uncertain, I think take your lump sum, divide it into 6, and allocate that into your investment markets in equal proportions over that time. But the one thing you really can't do is sit back and wait for things to get better. Because by the time I'm sitting on the show talking to Stephen saying, okay, everything looks good now, the price of all the assets have jumped up already in anticipation of everything being good. So markets look ahead and they respond very quickly to signs of good news, and generally will push prices of assets up far faster than any of us can hope to kind of deploy our cash back into markets. So I don't think you wait. I think you phase in to give yourself some sort of peace of mind, but actually you really want markets to be going down and for the world to be very unstable when you're trying to deploy a large lump sum.
Okay, no, that does make a lot of sense, and you sort of want to almost buy at the right time, which is, I suppose, what you would be doing. It's another way of putting it. The debate between active fund managers and indexes. How do you manage it? In the end, do you have a combination of the two? It's your old phrase, diversify.
Yeah, I think I've made peace with the fact that if I'm going to pay extra money to a fund manager, what I'm hoping for is that I'm going to take some of the money, put it in an index, and then I'm going to take some money and give it to a fund manager. And my hope is that fund manager is going to invest the money in things that are completely different from the index. And the plan there is some form of diversification where you're hoping that you get the returns of markets via the index, but the protection against very expensive sectors of the markets and potentially unexplored opportunities through a fund manager. And then what you're really aiming for is that 1 + 1 gets you to 2.25, because we know that there aren't many secrets to the investment world. Investment markets are well researched and monitored all the time, but I do think allocating a chunk, and for me it's about half of my money to an index, makes a lot of sense. I will do as well as everybody else in that instance, but then buying fund managers who do things completely differently to the market either gives me some protection when the markets go down because they own the cheaper assets, or it gives me exposure to things that just aren't listed. A lot of very big companies, if we think about SpaceX as an example, they're not even bothering to list anymore. So you need to find other ways to buy into those companies, and sometimes fund managers give you that access.
I suppose the other thing is that you do need to feel comfortable with what you've done.
Yeah. So if you're someone that's been listening to the adverts of a particular fund manager for the last 20 or 30 years, and your parents invested with them, and you have a high degree of confidence that they'll do a decent job for you, then all of the arguments about active and passive and choosing this or that doesn't really help if you believe that I'm going to allocate my money to a fund manager I believe in, and most importantly, that I'll stay there for the next decade or two. Because if that gives you confidence and comfort, and you stick to the strategy, that's a much better idea than buying an index because because I said so on the radio, and then losing confidence in 3 months' time when the first stock market crash happens and you lose faith. So staying invested really is the key in all of this.
Warren Ingram, thank you so much. Co-founder at Galileo Capital. Really interesting debate, and one that'll continue for quite some time.